So if you're like many people that I deal with in commercial real estate financing, you get overloaded with different deals that you need to review. Those deals come in all different shapes and sizes, all different property types, and it can be really, really confusing just to try to get to an NOI. Right? Because at the end of the day, you need to figure out what the NOI is before you can really do any kind of financing on this property. Before you can decide if you want to buy this property for an investor, before you get to your expenses, you want to deal with your income. You can take them either way, but the most important thing I can tell you is don't get confused. I don't care if this is a 1,000-unit property or this is a 5-unit property. It's the same system. It's the same process. And I'll tell you, I have financed 1,000-unit properties. I've financed a 3,000-unit property outside of Washington, D.C. We did the same thing, just bigger numbers and a lot more zeros. It doesn't need to get more complicated. I'm going to break income down for you. I will link to the other video, which does a deep dive into expenses. So now we're going to talk about the top part. I think of a spreadsheet. We're talking about the top part of the spreadsheet, which is income, because it all comes down to the money. It doesn't matter what you're doing. If there's no money, it doesn't matter what expenses, you're not going to have an NOI. So bottom line, let's figure out the money. First thing, rental income. This is really easy. You're going to look at the rent roll and you're going to figure out what the rental income is coming off that property for any given month. I'm going to do a simple approximation, and I'm looking at a multifamily property, but it's really the same thing on any property. And this is why the rent roll is so important, because it just gives you the cold, hard facts. In this case, we've got 20 units, and each unit is generating $1,000 a month. Now that never, I shouldn't say never, that rarely happens. He's got a mixture of 1 bedrooms and 2 bedrooms in a den, 1 bedroom with a 2-bath, whatever it might be. He's getting $1,000 for this one, $850 for that one, $1,150 for this one. Sometimes they've been there for 5 years. He doesn't really raise their rent. Other times he's pushing the rent. Whatever it is, it's going to be some bottom line number in the rental income. And I'm making a distinction here. This is a real estate property. It might be a hotel. It might be office. It might be retail. It might be industrial. It might be multifamily. And any other type that you can think of. You're only looking for the rental property, what I call the core rental income coming off that property. If it's a retail property, it's your retail unit lease. If you're an office property, it's all of your office rents. If you are a industrial property, again, it's your unit rent. If you're multifamily, it's your leases. Whatever it is, just focus on the core rental income. Now, there could be a couple of different types of rental income, but you're dealing with the unit income. And I'm going to show you why, because in a moment, just dealing with the rents of the space. That's what you're focused on in that top line number. And again, if you have a mixture, let's say you have a mixed use property, you might have apartment rental income, and you might have a retail unit on the bottom. That could be your retail rental income. You could have maybe you have office rental income. Now, every property has some kind of vacancy and credit loss. These are really two different things. It's vacancy and credit loss. Vacancy would be you're never going to run, or I should say, usually you don't run 100% occupied. Even if you wanted to, people move out, people come in, they're moving out in the middle of the month, and your rent roll will accommodate for that, but you want to put in some kind of actual figure there, and then your credit loss might be, your transaction fees, your credit card fees, people bad debt, people skipped out on the rent and didn't pay you the full month or whatever it might be. In general, we can estimate that at around 5%. If you don't put a number in, lenders will typically look at 5%, or they'll look at what the average is in the zip code or demographic area, whatever it might be, and they're going to put some kind of number in here. The sad truth is, even if you're operating at 100%, which is perhaps a great thing, meaning operating 100% is not always the best advice, because it probably means that you're not pushing rents. If you're pushing rents to where the most they could be in that market, and if you're maximizing the dollars out of your property, you're probably going to have people turn over because somebody's going to want to find a cheaper rent, or that you can't afford this rent anymore. But this owner, if your owner-operator has decided that they'd rather have a fully occupied property and not have to deal with turnover, not to have much of a sales team, that's a strategy. It's completely legitimate. But I can tell you that in many cases, the lenders are going to still come in and put in what they would call the market average vacancy and credit loss. And that, in some ways, that's a penalty. And it can be really frustrating to say, my gosh, my owner-operator has been managing this property at 98% occupied consistently for the last 2 years. The lender comes in, that's great, we're still underwriting it at 5% or 8% or 10% because that's the market average. And if you're a wonderful, very magical owner-operator, every ever disappeared off this property and we, the lender, had to take the property back, we'd have to assume we could get an average lender, or I'm sorry, an average owner operator. And that's how they're going to look at the deal. So don't be surprised by that. Just be prepared to argue on it. Have a pushback with that lender and say, no, we can consistently demonstrate that we get 95% or above. There's no way we're taking an 8% credit loss, vacancy and credit loss. And you can hopefully come to a middle ground on that with the lenders. And every little dollar amount is going to matter and going to help you boost your revenue. Because remember, the bottom line here is the more effective gross income you have and the less expenses you have, you're going to have your NOI. I'm pointing down here because you'd be down the screen to your expenses and then to your NOI. And you want to maximize that NOI to maximize your loan proceeds. So that's the goal with everything that we're doing here. Okay, so I took off my credit loss. I made a rough estimate of 5%. So that's $1,000 off. I come to my total income. This number is always a little strange what people call this number. It doesn't really matter. Total income, total rental income, net income, whatever you want to call it. We just understand this is kind of your net or your total rental income, okay? Because now what I want to add in here is all your other types of income. Now, some properties don't have much other income. Other properties have a lot of other income. So just as an example, what other income might be utility reimbursement. So there's a master meter in the whole property for electric, and then you rebill every tenant individually based on their own electric, or for water, or for gas, whatever it might be. It could even be for Wi-Fi, or for internet, or for cable, whatever it might be. That's utility reimbursements. You could have a laundry room income. So this used to be really common, much more common than I think it is now, when laundry rooms had, put a quarter in, a manual machine to get your laundry machine running. Nowadays, most of those have converted over to electronic. And so this is still an item. What I meant to say by that was that when it was coin operated, a lot of time that income would just kind of disappear. $1,000 here, $850 here per month. Again, I'm thinking of small multifamily properties. And because it was cash, it would just kind of magically get used and disappeared. But now that it's all electronic, it really will be a number because it's all recorded electronically. Larger parking income. Sometimes they're selling either garages or parking spots. So that's parking income. Storage income. Sometimes this is not self-storage income. This is just storage income. Sometimes in apartment properties or office properties, there might be storage in the basement or a shed out back behind the property that the owner of the property has put there and is now selling storage. All these are very common types of income, and I'm sure there are other ones. Again, could be cable income, could be Wi-Fi or internet income, and any number of other things that I'm not even thinking about or aware of, depending on your particular property, your particular type of asset. But just be aware, this is where property income comes in. Do not mix your other income into your rental income. Even though you might consider parking as rental income or storage, I'm renting a shed, I'm renting a space, I strongly suggest that you put it as other income and not mix it with what I call your core rental income. And primarily because, it's even a little strange. I was going to say because you don't have a vacancy or credit loss, but you kind of do. Because off of your parking, I don't know, you got 25 parking spots and, they're not all occupied. So 23 are occupied. There's a vacancy there. You have, 18 storage units and only 12 are occupied. You have a vacancy there. But again, I would just use these bottom line numbers in your other income. Don't mix them together with your rental income. Bottom line, rental income minus VCL gets you total income plus other income gets you to your effective gross income. And that's your EGI. I don't know why in commercial real estate we call this effective gross income rather than total revenues or total income. I don't know, but that's just what we call it, EGI. And this is an important number because when you get to your expenses, many of the expense line items are often derived from EGI. For example, the one I can think of most commonly would be property management. Property management is often a percentage of EGI. And there's a reason for that. And I'm not going to go into expenses right now, but just while we're talking about it, that would be because the property manager has an incentive to raise the income because they're going to get more money based on the incomes being higher. So just an example, and just to be on the lookout for that and to understand why that happens. But do not let this get complicated. Again, I worked on some very large properties in my career, and it can seem to get complicated. It can be hard to figure out what the actual rental income is consistently month over month. But you have the rent rolls to guide you. Get multiple different months of rent rolls. Compare those rent rolls to the rental income on a profit and loss statement, on an income statement, right? You're going to want to look at the income statements from the property, correlate that to the rent rolls from the property, maybe even correlate that to the tax returns of the property. And that's accounting work. So if you're not an accountant and you don't have an accountant that can help you, then you need to figure this out on your own. It's a little like being a detective. The simplest and easiest way to do it would be to use the rent roll. Where this is going to get a little bit confusing for you could be like this. You have a P&L statement, a profit and loss and income statement on the property for the trailing 12, and you have it by month. You can see the income coming in month after month after month. And yet that income doesn't match the rent roll. And that can be a little bit confusing. So my suggestion to you, without going into too much confusion, is just make your best estimate, either and be consistent, and either use the numbers on the income statement or use the figures from the rent roll. And just be prepared to justify what you've done with the lender, because they're the ones who are going to look at all this, or it could be equity investors. They're the ones who are going to look at all this. Just be consistent. If you're going to use the rent roll income, then use that on every different document that you create. And if you're going to use the income coming off of that's on one of the line items on your income statement, then use that. So we have another video deep dive into the expenses that'll help you get to your NOI. And that is literally 3/4 of the battle to get to a solid underwriting that you can defend to the lenders and that you can hopefully maximize proceeds for the borrower. Thank you very much. See you on the other side.